In this video, I'm going to be talking about some of the pros and cons when it comes to dividend income in particular. Hi, my name is Pascal Mangat and you're watching the Financial Ownership Podcast. So for those of you that don't know how a dividend works, essentially what a dividend is, it's kind of like a reward system when you're a shareholder or you own a share of a company or fund. So basically what a company will do is they'll pay you a percentage based on the value of your stock or fund every single quarter or every single month, depending on what type of fund that you have. And they'll pay you directly through, usually what they'll pay you with is cash. There's some things called stock dividends, but I'm not gonna go too much into that. But typically what they'll do is they'll pay you in cash every quarter. So let's say that you have $10,000 worth of Bank of America stock and it pays about a 2% dividend. That means that you would get an income of $200 for the year, and it'll be broken up into quarters. So 200 divided by 4, $50 every single quarter, around there, because the price does fluctuate when it comes to owning a stock or fund. The main good point when it comes to living on dividend income, say, is when you have dividends or you have dividend incomes from your stocks or funds, you never really have to sell any shares of the company that you own. So you still have ownership and equity of the company. So you can't really run out of money, considering that stock or fund that you got is a good decision and it doesn't go bankrupt. So it's like an infinite source of money. So a lot of people get some security of knowing that they're not selling their shares and they're getting income from the asset, and that income could potentially last their entire life. The bad thing is that a lot of dividend yields aren't that high currently. If you look at some solid funds or solid ETFs which is basically an exchange traded fund, which is similar to a conglomerate of stocks or bonds. If you look at two exchange traded funds, VOO and BND, those funds don't really have that high yields, and they're solid funds. Basically, VOO mirrors the S&P market, and BND basically mirrors the bond market of the high grade AAA rated securities and things of that sort. And if you look at the average of those two, it's about like a 1.7, 1.8 yield total that you would be getting on your portfolio. So basically, if you have $1 million that you have in your portfolio, and you're getting a 1.8% yield on that portfolio, you're basically getting about $18,000 every single year from your dividend income just through that. And if you think about it like this, like most people, 18 grand in terms of income from their portfolio, if that's a major retirement source for them, isn't gonna really cut it. There are ways to get higher dividends, and I'm gonna go into that later on in this video. But if you're familiar with the 4% rule, basically what the 4% rule is you could take 4% of your entire portfolio, and then afterwards you just adjust it for inflation afterwards. So let's say you have that same $1 million portfolio in a mixture of stocks and bonds. 4% of that would be $40,000. You would make sure that you have a total income from that portfolio of $40,000 for the year. And then afterwards, what you would do is adjust it for inflation every single year. So that $40,000 will get adjusted for inflation every single year. So $40,000 based on this year of 6.29%, that is about $42,000 in total income that you would be taking from last year to this year if you followed the 4% rule and you took $40,000 from a $1 million portfolio, and you would just continuously adjust the amount that you took out previously to inflation to make sure that you're keeping up with the rising prices of goods and services. So that's how the 4% rule works, and that's what a lot of people can use if they want to stay in a portfolio and basically use it for their entire life without having the concern of running out of money. And this rule has been tested, so it's relatively good to use if you want to be a little bit more conservative. Maybe instead of like 4%, maybe you take 3.5% of your portfolio. It all depends on what you're trying to do. Or you could just go through an entire dividend-based strategy where you're getting income from your investments. And I'm going to talk about a little bit of some of the risks that you might want to pay attention to before you do something like that. Well, another good thing when it comes to living off of dividend income, if you want to think about it, even though you're underspending, if you're living on, say, a 1.8% dividend, let's say you are in a position where you can afford to only take that small amount of 1.8%. you get to leave a very big benefit to your loved ones or a charity of your choice, right? Because if you're only taking 1.8% of your overall assets and you have about $1 million in terms of what you save for retirement in stocks and bonds, you're most likely never going to run out of money, considering that you got like things like the total S&P market index and the total bond market index. You'd pretty much be safe and not have to worry about any type of the market crashing and losing all of your money. But one thing to note is you are going to have to deal with market fluctuations. So if you think about it, a dividend only pays a percentage. So if you have, let's give an example. If you have $100 worth of Bank of America stock and you have a 2% dividend on it, that would pay $2, right? But let's say the stock was cut in half and it was still paying a 2% dividend. Now the dividend will only be $1, even though that percentage stays the same. So you're going to be subject to things like fluctuations, and that could be a determining factor on how much income that you have from your stock market assets from dividends, which is something you really might want to consider, especially if you need a certain amount to retire. You might want to have some margin of safety if you're going to use a dividend strategy. But if you want some higher yields, let's say like stock funds like VOO and VTI and some of those other stock funds that are out there that you can buy, you're not satisfied with the yields that they give. There are funds that are yield focused, not as much growth focused. So if you think about a fund like QYLD, which is basically a covered call writing fund, which basically really means in English, it's just a fund that's focused on income and it's not focused on growth. So it's pretty fixed in terms of the growth of it, but it pays out a high income. So this stock fund paid around like the last 10 years, it paid over 10%, which is relatively high. But you're gonna have to take a sacrifice in terms of accumulation of your assets if you're gonna follow a strategy like that. That's why I wouldn't recommend anyone use an entire strategy or use all the money in a strategy like QYLD, because you're putting yourself at risk to inflation, especially nowadays when it's extremely high. So when you're using a high yielding fund like a QYLD that pays a 10% dividend, you have the potential to miss out a lot of appreciation in the stock market. And you run the risk of the stock market completely outperforming whatever dividend yield that you're getting. So that's always a risk when it comes to using a strategy like that, especially when it's a high dividend yielding strategy. If the stock market performs, like if you just get a regular growth focused fund, let's say like BUG, that doesn't pay high dividends, more of your money is going to be growing and compounding in a fund like that, because it has low dividend yields and most of it is growing inside of the fund. Versus if you have something that pays high dividend yields, you don't have as much money growing inside the fund, so you can have lower appreciation. So you kind of want to find that balance in between, where you have a portfolio that gives you some decent types of yields in terms of your portfolio, in terms of dividends, and also gives you the benefit of just pure growth. So one thing that you really want to pay attention to is total income, not just dividends. So what total income is if you have a stock and it grows from $100 to $200, let's say for example, and part of that dividend, and part of that was a $10 dividend, and the other part of it is 90% appreciation, the total growth is $100. So the total growth is basically dividends plus appreciation. So what you really want to be paid attention to is what your portfolio is actually giving you in terms of value. And that's, at the end of the day, is what really matters, is how much money you can use. The 4% rule can work as long as you accumulated a decent amount of assets in your portfolio. There really isn't an age where you have to decide that you can use something like the 4% rule, unless you're using some sort of retirement account. But if you just have liquid access to your stock funds and your bond funds, what you can do is you could use something like the 4% rule earlier, and still, and if you want to be a little bit more conservative, say like take maybe 3% of your portfolio only, and still not have to worry about running out of money. But if you actually analyze it, growth funds have completely outperformed a lot of these high yielding funds. That's if you look at the short-term data right now. Is that going to be the same in the future? We don't really know. But right now, having more funds that are focused on, based on previous data in the last 10 years, having funds that basically didn't pay high dividends and just will focus more on growth had more total return than the dividend yielding funds. Does that mean that you should never use dividend yielding funds? No, I don't really agree with that concept. I think it's good to have a mixture of both and to make sure that you're not putting too much of your eggs in one basket. And especially if you're at the point where you don't have a lot of assets, I would say that it makes a lot of sense to be much more focused on growth than you want to be focused on income from your investments like dividends. You want to make sure you grow your basket to a decent amount of money, say 200, 300, 500,000 before you actually think about taking income from your investments. So this is a little bit of a spiel on how it would be like in terms of living on dividends and how it exactly works. So if you found some value in this video, go ahead, like, comment, subscribe. I post financial content every single week based on things about the stock market, different types of financial products. So if you're interested in topics like those, subscribe to the channel. And if you have any question, in the description below, there's a link to my link tree. If you want to ask me a question about the stock market or some sort of financial product, feel free to contact me there. Thank you.